within a few years, we're going to have days where gold is going to be up a couple $100 in a single day. And then and we're going to see, once you see silver take out, I think right now, probably the next major important hurdle for silver is about 35 to 37. That's sort of an important quarterly close. That's going to be a big milestone. After that, the clear next upside milestone is going to be $50. After that, we're in uncharted waters, and I think we're going to see some big gaps upward from $50. You can see 70, 80 matter of days or weeks after that. So these have forever been safe havens.
PeterKrauth, former portfolio advisor and current publisher of the Silver Stock Investor, offers a seasoned perspective on the long game in precious metals. Krauth breaks down why gold and silver are once again front and center, not for hype but as protection against systemic imbalances. Looking back, Krauth notes the 1970s as a key precedent. Between 1966 and 1982, gold rose roughly 14-fold, while equities like the Dow and S&P flatlined. Silver followed a similar trajectory. These weren't short-term speculative runs, but fundamental shifts as capital sought refuge from monetary erosion. Fast forward to today, gold has risen from $250 in 2000 to over $3,000, up 12 times. Silver has risen from $4 to the mid-20s, nearing a similar trajectory. Yet despite the gains, Krauth says the public remains largely disinterested. Instead, they've chased overvalued tech and equity markets, ignoring metals, even as central banks and institutional money quietly rotate in. He highlights a crucial point. The smart money is already there. Early movers are reallocating into metals as a hedge against extreme equity valuations. As broader investor tiers catch on, retail included, we'll likely see the kind of price action that leaves latecomers scrambling. Krauth expects $100+ gold days and silver to surge past key resistance at $35 to $37, with $50 as the next milestone. Meanwhile, physical tightness is growing. Massive metal flows from London to New York signal a rush to secure supply. Silver inventories are at decade lows, premiums are soaring, and COMEX deliveries are hitting historic highs, despite being an exchange not designed for mass physical settlement. For those paying attention, the message is clear. Physical metals are being hoarded, not traded. Now, we present the latest clips of PeterKrauth's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Just have to look at the 1970s. Gold was up, I think it was something like 14 times between 1966 and 1982. The Dow and the S&P were flat over that sort of 14-year period. So you have these extended periods where precious metals clearly outperform. And you just have to look at where gold was in 2000, which was about $250. We're more than 10 times up from there. Silver was about $4. So we're almost 10 times there as well. These are long-term trends that I think have not finished playing out, and there's certainly something that people will want to pay attention to and gain exposure to. If you ask someone, 15 years ago when gold was at, I don't know, let's say, $500, $600, $700, if they could see a time where it was going to go to 2,000, they thought you were crazy if you said absolutely it's going to 2,000. And today we're at 3,000. We're 50% above, that kind of level, and yet people are really just only sort of starting to get interested. We've started to see funds really shift and flow into physically backed precious metals ETFs, which it's interesting. If gold can go from 2,000 to 3,000, and funds will flow out of these ETFs. So it tells you that the appetite was not for the metals, despite there was no chasing in a sense, really. There was no chasing these metals prices higher. What investors were doing was they were chasing stocks. And so I think we're starting to see a big rotation start to happen, especially now that we've had this huge correction. I think the smart money was getting into precious metals because it saw the extreme overvaluations in stocks, and the smart money was in early. And I think now you're going to start to see that trickle down from smart money, to sort of more sophisticated investors, and then you're going to get moved towards this sort of regular informed investors and down to the dumb money, so to speak. And that's going to take a while to play out, and then you're going to have a lot of fear of missing out, and that's when you're going to get these huge run-ups, these I mean, within a few years, we're going to have days where gold is going to be up a couple $100 in a single day, and then and we're going to see, once you see silver take out, I think right now probably the next major important hurdle for silver is about 35 to 37. That's sort of an important quarterly close. That's going to be a big milestone. After that, the clear next upside milestone is going to be $50. After that, we're in uncharted waters, and I think we're going to see some big gaps upward from $50. You can see 70, 80 matter of days or weeks after that. So, these have forever been safe havens. They're still in many ways, on many metrics, relatively cheap. And so I think that there's a lot of runway left in both metals. People just need to start to have at least some kind of exposure.
PeterKrauth emphasizes what many overlook. Today's metals rally isn't driven by hype but by scarcity and strategy. He points out that gold and silver ETFs saw outflows for years, even as prices rose. That means institutions weren't chasing price. They were shifting focus. They were moving into physical metal, off-market, and into private vaults. Behind the scenes, COMEX deliveries have exploded. Silver, in particular, saw its second-largest delivery month in March, going back as far as 2007. This isn't just investor enthusiasm. Industrial users, strategic stockpilers, and short-covering parties are all demanding real metal, not just paper claims. Meanwhile, the flow of metal from London to New York speaks volumes. London's silver inventories have cratered, down to 10-year lows. The smart players are locking supply ahead of potential tariffs or systemic disruptions. Krauth sees this as a significant inflection point. Once silver breaks $50, price discovery could go vertical, and that's not a prediction. It's a historical pattern. Let's get back to the interview.
I think that the error was not taking deliveries more gradually earlier. That was the error. Waiting and wanting to try and do this all in one shot. I think that what we've seen happening with these huge flows of gold and silver from London to New York are very indicative of. I mean, some of it. So there's a couple of arguments. One of the big ones is the obvious one that there was concern about tariffs on these metals. So if someone had to deliver into a contract before a certain deadline, with tariffs potentially having been added to these metals, that they didn't want to get caught offside and have to deliver metals that they didn't have on hand and have to pay this, whatever it might have been, say 20 or 25%. That would obviously sink a bunch of institutions. So they tried to front run it, so to speak, get the metal into the U.S. And have it available. What I find interesting is that you're right. There are these contracts with large amounts that are standing for delivery. I just saw a chart where March deliveries of silver had their second highest ever. If you go back, I'm not sure how far back they track, but the chart that I have goes back to 2007, and it's a clear standout that people are taking physical delivery from the COMEX for their silver and their gold. And this is unlike the Shanghai, for example, futures exchange. This is an exchange that was not set up for physical deliveries. So, I think there's two things happening. One is that it's a question of being able to, there's probably three things happening. There's probably, some of these are participants that want to have the physical metal to offset some shorts. I think that you've got some industrial consumers that want to get the physical in their hands because they need it for a production of all kinds of things, anything from solar panels and EVs all the way to military applications. And then you've got a lot of these deliveries. What I've heard is that not all of these deliveries are going in and staying in the COMEX. They're actually the metal is flowing to New York and then is going into private vaults in the New York area. So I mean, there's obviously very little information around that, but these are the kinds of things that I'm hearing. And, if you look at the London inventories, I've got a chart in front of me, and I mean, it's at 10-year lows, and it's dropped off. It dropped off dramatically in 2022, and then it's dropped off again dramatically in the first 3 months of this year. So obviously, the last few months, that's because most of that will have flowed to New York. But London is the largest, has the largest inventories, or still has, I think, the largest inventories of silver. So it's starting to get really, really tight in terms of physical supply, and the exchange for physical premiums on silver have been through the roof. So that means that market participants really, really want to get their hands on physical silver, and they're willing to pay for it. So that really, again, speaks to very much clearly speaks to tightness in the market, and I think it speaks to a little bit of anxiousness. Participants really want to have their hands on the physical silver, are uncomfortable with with futures, and yeah, I mean, again, just to kind of summarize it, I think the draining of these secondary inventories, both, where all three, New York, Shanghai, and London, speak to the need for physical to meet demand.
PeterKrauth concludes with a clear message. If you're not already exposed to precious metals, now's the time to reconsider. This isn't a typical cycle. We're witnessing a structural rotation. Central banks are hoarding metal. Gold and silver remain the oldest forms of real money. And in an environment of rising debt, inflated equity markets, and eroding fiat trust, they're quickly reclaiming that role. Silver's technical breakout is just the beginning. With physical tightness growing and emotional capital, FOMO, on the horizon, Krauth believes we're entering a phase where metals will move not in percentage points, but in leaps. Share your thoughts on PeterKrauth's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.